and welcome to Economy and Markets TV, where we have conversations with a purpose. I'm your host, Dave Oakenquist, Senior Research Analyst here at Dent. Joining me, of course, is Mr. Rodney Johnson, Senior Editor and co-founder of Dent Research. Rodney, good morning.
Morning, Dave.
Rodney and I are going to take you around the world of economic and financial news as we do each and every week. We cover about 3 or 4 big topics that happen during the week, try to keep things moving. The bell keeps us in line to about 2 minutes, sometimes with a little bit of play there. But if there's something important, we want to get it to you. But with that, let's move on to the big news of the week, Rodney. The Fed, Chair Powell hints at a pause in rate hikes. Of course, we're pretty sure December is still happening, but looking forward, it's very uncertain. It's sounding a bit like Janet Yellen. We're going to be data-driven again. And this news sent the markets higher about 600 points. So that's really good news, right, Rodney?
Well, it is for some, right? And it's something we've talked about for some time as one of the potential positive catalysts in the marketplace. Because when the Fed, takes a hiatus on raising rates, it means that you're not looking at bonds pulling some of the money away from equities, and equity valuations remain the same because higher rates mean that equities have to yield more to give you the value back and things like that. But I don't think it's going to last. We're looking at this, and the Federal Reserve is doing what we had said, where they got to kind of a neutral level, and now they're going to hold off, and they're going to see what the future brings. They're really talking about asset prices, talking about bond prices and stock prices and even housing prices, because the things they're supposed to focus on, meaning very high employment, very low unemployment rates, and then moderate to stable prices, they've done that. And so they should be raising rates here. And so I think they're kind of looking broader than they normally have. And they're saying, hey, wait a second, we want to screw some of this up. But they're not going to fix the bigger issues, which is companies are going to have harder earnings comparisons come the beginning of 2019 back to 2018. And we're going to look at this and say maybe GDP slows down, as we've been talking about all year here. We thought this pop in GDP was going to slow. And looking at the trade deal and looking at a split Congress and saying maybe perfection is fleeting. Maybe that's over. And so we do have difficult times ahead, and the Fed can't really change it.
Now, to your point, the Atlanta Fed's GDP now, which we track here, there's Q4 is slated to come in at about 2.6%, so definitely a slowdown there. The Fed also released a financial stability report, which suggested a market drop or a possibility of one, which you kind of hinted at there. But so if those trouble signs are ahead, isn't this prudent policy to maybe say, hey, we might not be going forward with all these rate hikes?
Well, it may be prudent policy to slow or stop. They put out there this data-driven language, which says basically we can do whatever we want whenever we see it. And the fact that they're looking broader, they're looking at asset prices, they're looking at markets, meaning financial markets, I think it's terrible policy because it puts everything in question. The markets, investors, people are planning or trying to plan based on what they think the Fed might do at some point, which I think is terrible for a central bank. It should instead be mechanical, like the Taylor rule, where you have, X amount of unemployment, Y amount of GDP growth, and, Z amount of inflation gives you this particular monetary policy. So we all know they shouldn't be the great unknown trying to steer the economy. They should be very much in the background. That's it.
Yep, agree, very much so. Now, something that the Fed probably has their eye on is the housing market. We got sort of some bad news out of that this week. The National Home Price Index, the yearly price growth fell from about 5.5% to just over 5%. So we're sort of seeing this slow downtrend in prices. Yep. Of course, as you noted in the copy, rates have been moving up recently, so that's probably weighing on that. New home sales, Rodney, those fell 9% for the month, 12% for the year. We're seeing a fall in prices there. So what's your outlook on the housing market, Rodney, and what this could mean for, maybe if rates are going to maybe not go higher anymore, maybe this could be something that could keep it afloat.
Rates are already, in terms of mortgage rates, they're already a percentage point or more higher than they were a year ago. And we've been talking about the other side of this, which is affordability, for a long time. And it's been a couple of years we've been talking about this yawning difference between home prices moving up very quickly and incomes not. Mm-hmm. And so we've been talking about the fact that something had to give. And as the real estate market slowed down, that obviously was the give. And now with higher mortgage rates, well, it's just getting more pronounced. Right. And so I think it's been a long time coming. The housing market doesn't turn on a dime. This is, the proverbial aircraft carrier. It takes a long time to start to turn, but once it starts to turn, it takes a long time to stop. And so I think we have more pain in this area. The good news, if you want to call it that, is we're going to bring prices back to a more affordable level for people that want homes. And housing never recovered in terms of what it was as a percentage of GDP in the early 2000s. And so it doesn't have the same effect in terms of employment and knock-on things that it did before. It's still important. Clearly, it's still important. And we do have a lot of trade jobs, middle-income jobs involved. But because we never got back to the 1.2 million new units a year, it's not as big as it was, 15 years ago.
Yeah, absolutely. Yeah, we mentioned new home sales are only about 10% of total, and buyers have, as we've talked about for a year, at least in this space, that the builders rather have been very cautious about what they do. We're not just pouring in with these massive tracks that when bottom falls out, it's devastating. So it is a little different this time. That's all I had on that topic. Let's move on to energy, Rodney. Oil fell below 50. And one thing we talked about, the worries of the Iran sanctions, the absolute disaster that's going on in Venezuela. But meanwhile, the U.S. is going full steam ahead on production. So we're getting back to this 2014, 2015 world oil glut again?
I don't think so. Oil is a world of course, supply and demand. On the supply side, we had the worries, as you mentioned, Venezuela and Iran. Venezuela is still in the toilet. Iran, we granted sanctions to basically anybody who wanted one. And so they're still pumping a lot of oil. Yeah. The Saudis had the production cuts along with the rest of OPEC and their, band of merry men like Russia and other providers from 2016. But then they blew through those when oil started walking up to very high numbers earlier this year, around $80 a barrel. And so what we're looking at now is a slowdown in demand as people look out in 2019 and go, hey, wait a second, maybe global growth isn't what we thought it was. And the supply increase, both with OPEC and other members, as well as United States continuing to produce more. And now everybody's saying, wait a second, now we have too much again. And so I don't think we're in a position where it's going to be a problem because Saudi Arabia already has those production quotas listed. I think they'll go right back to them when they meet in about 6 days, and then you'll see the price of oil walk back up. But as you mentioned, the great news is here in the U.S., we're set to produce 12 million barrels a day next year, which is fabulous. It makes us the largest oil producer on the planet. And so they cut production, the price goes up a little bit, and a lot of money stays here in the U.S. I'm happy with that.
Absolutely. Great news on that. Now, another bit of news, natural gas prices in West Texas and New Mexico fell below zero. Now, you have an upcoming article on Boom and Bust coming about this. We talked about natural gas. We saw a spike in prices, but why is it below zero? What's going on with the natural gas market?
It's all about where you are, right? Natural gas, if you go look at the spot price, I assume it's around $4 a day, $3.50. It spiked from where it was. And natural gas in the United States, that's the Henry Hub price, is about $4 or $5 less per million BTU than it is in, say, Asia, because you have to get it from one place to another. And unlike oil, natural gas is very hard to transport. You either do it in a big pipeline and it's, form that it comes out of the ground, or you have to liquefy it at negative 260 degrees. And so it takes a lot to get it on a ship and get it across the ocean. Okay. Well, when you produce oil or when you extract oil, you tend to get a lot of natural gas. In the Permian Basin in Texas, they're extracting a lot of oil. They're getting a lot of natural gas. They're getting so much, there's no place to literally store it or transport it. And so they do what's called flare, where you literally burn it off. I mean, you light it and it burns. And so granted, people aren't very happy with just burning the natural gas into the atmosphere right now. And so what they're trying to do is find anybody that'll take it, to the point that producers are actually paying transport companies to please take their excess natural gas. And so the price is technically below zero.
Interesting. Now, I did mention the upcoming Boom and Bust issue, which should be coming out in a couple of days. Which is on energy. Do you want to just talk a little bit about that for everybody listening?
It's really more of a longer piece on oil and how we got to where we are in oil and the very short or very small market that is. The fact that it's controlled by some and the price will go back up. And so we shouldn't take the current price to be, hey, a sign we're going back to 25 or $30 a barrel. That's not what I see.
Great. Can't wait to read that one. Just looking ahead to next week, we've got factory orders, U.S. employment situation. Thank you all for watching, and we'll catch you all next week.